Right, welcome to Fast Markets and Axel Rudolph's first ever appearance on Fast Markets. Welcome, Axel.
Thank you very much, Rich. Glad to be here.
Now, the reason for the invite is because Trade of the Week was so successful that we've got to bring you on Fast Markets because that was an absolute belter you had on Tuesday.
You know what's really interesting? Before we talk about that trade and, the short NASDAQ trade that, I've been sort of quoted on social media for quite a while now, those are just two trades out of the trades. I'm more focused on the next 1,000 trades than on my current trade or yesterday's trade.
Yeah.
Because what's really funny is when we started off, if you remember Trade of the Week at the beginning of the year, we got 4 trades wrong in January, one after the other. And I think we were down about 6.6% or something like that. And at that time, a lot of people who followed it last year when it was up 31% thought, you know what, this doesn't work. Even though I said, last year we had 2 occasions where we had 4 or 5 trades in a row which went wrong. And here we are, a few months later, and we're up again. Those losses are made back. Everything's fine. But you need to be aware that you can get these series, even if you're the best analyst or trader in the world, of getting those trades wrong, and you can have 4, 5, 6, 7 in a row wrong. This just happens.
And that's where the discipline comes in. It's so important to get your sizing right and your stops, and that's what leads you to get through these tough times of 4 or 5 trades going wrong, because then you come in, with one like on Tuesday. So just run everybody through what you pulled off on the DAX on Tuesday.
Well, I didn't pull anything off. I mean, what I usually do, I look at the charts. So basically, what did the charts tell us all? And you could have done the same analysis, and you probably did. We could see here that on the German DAX 40 daily financial bet, you had this downtrend line. So we had 3 touching points. You can see here, perfect touching points. And then on Tuesday, what we had was this break through the downtrend line. And also we were just about testing that previous high. So the odds are pretty high. And to be honest, I looked at the intraday charts as well, and I already had a setup on the intraday chart. So mine was actually quite a bit lower than the entry point we got, because as I always say, you can't come up with a trade idea at 10 a.m. or 9:30 a.m. every Monday. It could happen at 6:30 a.m. It could happen at 4 p.m. Who knows? Yeah. But anyway, the setup was there. We got the break of the trend line, and the odds were that if we were to break through that downtrend line and then close above the previous reaction high, which was going back to Thursday of the previous week, it was extremely likely that we would go and retest at least these highs from the 9th of April, but probably also a bit higher. And that's exactly what happened. We just shot up, obviously helped by Donald Trump backpedaling a bit.
Yeah, certainly.
But we didn't know that. But it doesn't really matter. If you look at the charts, all you're looking at is probabilities. And sometimes you get them wrong, sometimes you get them right. What is important, as you said before, is what size you risk and where you place your stop losses in case things go wrong. And this time it worked out fine.
Great. And is there anything that's you've noticed in charts at the moment that you're keeping an eye on, you're interested in, maybe is just some early warning flags?
Volatility. So basically, yesterday, for example, it wasn't that relatively speaking, that volatile on the DAX, for example, as you know, I traded. And then suddenly we got that sort of news out that perhaps the US will now start to lower tariffs on China. Suddenly the DAX shot up 250 points, then it was down 200, then it was up 100, down 100 within minutes. So when that happens, I just stay away. So when the volatility becomes crazy, I know a lot of people want to then really, really size up, and make big profits. But because it's so volatile, it's much more stressful to trade. You might get false signals. And also what might happen is that you can lose a lot of money very, very rapidly. So for me, those times are not times to trade. Those are the times, if I do have longer term positions on, where we'll reduce my size and not increase it. So that's the only thing I would say. We are in this time period now where suddenly we can have these big surprises and the market could just move crazy distances. So if you have positions on, and I believe we still have at IG free guaranteed stop losses until the end of the month.
That's right.
I would urge you to use them, especially if they're free, because that way, if you get a 200-point move and for example, you had your stop in, you might get, a really bad slippage on that trade. You might lose 50, 60 points.
Yeah.
If it's guaranteed, you get out exactly what you think you wanted to get out at. Great.
Can we have a look at what would you rather first, S&P or FTSE?
Let's just do the S&P. Okay. S&P is really interesting as well because we hit that same resistance as we did on the DAX. On the DAX, we managed to go above it because, as you know, a lot of investors are switching out of US equities into still relatively cheaper European equities, and the preferred market is the German stock market. So that's why the DAX is outperforming still. But you can see here the S&P rallied and basically retested its high from the 14th of April. Didn't even manage to reach the previous 9th of April high. So here we are relatively speaking weaker, as we can see. So we've got this huge resistance area, and also, and for me, technically, this is really important, we've got the low from March, which comes in at, on this daily financial bed, 5,503. So that whole cluster of that low with this low here from the 31st of March, these previous highs here in April, and the downtrend line, which in this case hasn't been broken through, all represent a lot of resistance. And I wouldn't be surprised if in the next few days we might perhaps have a retest or not even have a retest and fail here and maybe come down again. So for me, what I perceive to be a downtrend at the moment, in my opinion, isn't over yet. And it will only be over if we manage to rise with regards to the S&P above the 25th of March high. So that's quite a way higher at around 5,790 points.
Oh, wow. Yeah.
The index itself. So that for me would indicate, okay, that's just a big ABC Elliott wave correction, and now we're going to go up. But unless that happens, this major resistance area is more likely to cap than not, and we could have another descent towards last week's low, and if we go through there towards the low we saw in April so far.
Okay, so 5503 is the first important level, and then 5,790-ish?
Yes, it's basically the high from the 25th of March. If we go above there, then that's just been a correction here, this whole phase since basically early March. And the worst is over and we're going to go back up again. That would probably happen if Donald Trump were to reverse all his trade tariffs. And yeah, exactly. The questions are, will he?
This is what I like about this analysis, because it ties in with my fundamental work as well. As I've had up on screen, if we're talking basically at the moment, are we talking a $266 EPS, and are we putting that on 21 times earnings, or we put it on 20 times earnings? And the very maximum I can see is about 5,850, but much more likely is this area between 5,200 and 5,500. So I completely agree that we're in that, what's going to be that way. Yeah, that way. We're in this downtrend with 5,500 as the resistance. And I'm maybe not talking about getting back down to the lows. I think more a consolidation in the 5,200, 5,300 area.
We may well see that. I mean, nobody knows. I'm just looking back to, having seen these sort of markets before in the past, and the sort of V-shaped reversals we saw in the COVID bear market, the very sharp move down and very quick sharp move up, are rarer than a retest of the low, quite often making a new low and then reversing, or even sometimes making, as we saw in 2008, for example, a third low and then turning. The problem is, if we drop from here back to the low, we're talking another 10%, aren't we, easily? So don't forget, in 2000, 2003, we saw some markets go down over 50%. So NASDAQ went down 89%. So we all think, oh, that's in the past, it can't happen, not with AI, etc. I'm not saying it is going to happen. All I'm saying is what we've seen so far could just be a correction in the bull market. Fine. In that case, it's done. Or it could be something a bit more nasty. We could enter bear market because we're heading into recession territory globally, and that could last a bit longer and be a bit more painful.
Yeah, and again, to marry it up with the fundamentals, what we're saying is, are we going into a recession or not? And you've got 3 to 4 months of slower economic data, increasing job losses, maybe concerning inflation prints. No action from the Fed indicated by Powell, depending on whether he takes his little elbow from the president or not. So companies aren't going to be able to come out with the guidance that they did in Q4. So it kind of all marries up. Everything marries up quite nicely for, these people that are buy the dip. Just, we got up to 5,450 yesterday, and it didn't last long. And if the resistance is at 5,500 and the news that is going to be coming out over the next few months isn't particularly positive, then I'm not sure even tariffs going down to only 60% rather than 120% necessarily put us into the bull market. What is in the bull market, of course, is gold, Axel.
It is. We can have a look at gold, and gold did come off the last 3 days, but it came off from where? I mean, come on. It's gone up to basically $3,500 per troy ounce, all-time record. And yes, we see a correction because obviously at the moment, because of that de-escalation and the potential de-escalation, we should call it, in the trade war, at least rhetorically, it is a de-escalation already. We see some profit taking, but that's totally normal. And what we also see is the US dollar basically bouncing off its 3-year low. Mm-hmm. That means that for investors outside of the US, the gold bullion becomes more expensive, and therefore that's also conducive to the gold price coming off a bit. But let's look at the trend, because as you know, I love looking at trends. This trend to me is still very healthy. I mean, even if we were to take out yesterday's low, I mean, we might see a sort of ABC correction, whatever. Where's the next support? Well, we've got this low going back to the 14th of April. That's 3,194. And then we've got the high going back to the 3rd of April. So I always look at clusters of previous lows and previous highs. That's at 3,168. So in that area, we've got pretty good support. Basically, as long as we stay above that, for me, the medium-term uptrend is still bullish. That's just a short-term move down. Yes, given the bearish engulfing pattern we saw on Tuesday, where you had this body engulf the previous bullish body, we could see a consolidation phase now, and it's unlikely that it would take out the high anytime soon. By that, I mean in the next week or so. Okay. But the trend is your friend. It's still pointing higher with regards to gold.
And what happens during that period of consolidation? Because remembering that we trade options as well, right? So what I'm hearing there is the potential to sell a put at 3,150, take that premium, but perhaps the upside is capped as well. So, selling a short-term call at the highs might be a way to take premium in on both sides.
Definitely. I mean, if you've got the time decay in your favor, selling options makes sense, and it is pretty unlikely from a probability point of view that in the next 4 or 5 days we'll take out that previous high at 3,500. So you could definitely do that. Longer term, I have still, but I don't know what the timing of that is going to be, an upside target, a Fibonacci extension, which comes in at $3,755 per troy ounce. So that's, and it has been my long-term target for over a year now. That's a long-term upside target. But short-term, it does look a bit toppish here, to be fair.
What was the upside target? Sorry, Axel?
3,755. That's okay. My main target. And there's a cluster, it goes up to 3,800. But that whole area in the future at some stage might be hit, because technically we've got some upside targets there. But we don't know when.
No, that ties in with, everything as well, the kind of the noise of a continued budget deficit, continued, how do you say, from the government side, ill discipline, let's call it, in management of the debt. And I'd just be interested to see what effect it has on Bitcoin. And we've had the gold move. I just wonder if we get some flow out of gold and into our digital gold friend at some stage as well. Axel, that's been absolutely wonderful. Thank you as always. We look forward to Trade of the Week on Monday, after such an incredible result. No pressure at all next week.
Thanks, Rich. See you.
Thanks for joining us.